Yeah, of course there can be some overlap, but yeah.
Normally, also not everyone attends. So I don't know, but face to face, the industry we have churn rates of 50%. So
yeah. But I think the topic is very interesting. So like like in the I think in the previous advertisement we put the links on Teams. So therefore, like people may confuse. Like last time when we checked the number of attendees is going to very high, it's like more than 300 people like that. So we decided to change the link for the webinar. So might be some of them still going to the link with the Teams one, the team meeting. Yeah, so we put a persons in there already to let like other people, if they join with the link team, they will go with the
one question, so I can share screen, obviously.
Yeah,
can I use the chat?
So.
Can I use the chat?
Yeah.
Can I use the chat, the webinar?
Yeah, should be.
Okay.
Let me ask my team members to see whether it's like.
Yeah, don't worry. I'll try, and if it doesn't work, no problem.
Yeah, can you try share screen to see whether it's going on now? Because I think you're on panelist already.
So host disabled.
Host is disabled.
So I'm disabled. Host disabled. Participant screen sharing.
All right.
You did not see the button share screen on your screen?
Yeah, but it's disabled. It says host disabled participant sharing screen.
Don't worry, I will make you as co-host so that you can share your screen.
Maybe a panelist is considered to be a participant.
No, now you can try. I think you are now is co-host, so you have permission to share your screen.
Yeah. Okay. Look good now.
Okay.
Yeah.
You get it. Okay. So our webinar now is streaming.
Yeah, that's all right. Just a few minutes before that, so we can say hello to each other.
I'm not really looking at the chat, but if anything exciting in the chat, just let me know.
Yeah, sure. Let me monitor the chat. Yeah, so I can monitor the chat, and I can also summarize the question as well. So that's yeah, and yeah. Okay, and at the moment we also live streaming on Facebook as well.
Live streaming on what? Facebook.
Facebook, yeah.
Wow. All right.
Yeah. So strict, further because many Vietnamese scholars, like within our country, maybe they do not really use, enters into the Zoom's link or thing like that. So or they miss the registration, so they can watch out in the Facebook one. Yeah. Right. The quality look very good.
Let's hope the Australian internet keeps up. It's not that reliable.
It should be, right? It's at least you also have 4G over there, or is it going to 5G already? All right. I think maybe we wait for a few more minutes.
Yeah, don't worry.
Yeah, so people can get in. How's the weather over there, Harry?
Well, sunny. So it's actually my favorite time in the year.
Okay.
Sort of August is winter is a bit cold, and then sometimes rainy, and then as you get in August, September, sunshine almost every day, blue sky. You know, Sydney, beautiful city, and lots of harbor, water.
Yeah.
And at the moment, everything is very quiet. So lots of birds, and even in the city,
yeah,
lockdown.
I miss Sydney too. Yeah,
it's a nice environment.
Right.
I guess and you know, when summer often gets too hot, 40, 50 degrees. But sort of from now to October, November, beautiful.
Yeah. Australia in Auckland is freezing.
not a bad place to be in lockdown and Corona and all that.
Yeah. Yeah. All right. I think, yeah, let me check.
You also want to say a few words about AVSE and, you know.
Yes, I'm gonna.
Is that the first seminar you're organizing?
It's the first external seminar, yes. We conduct some internal seminar already, also open for others as well. But yes, this one is officially the first external one.
Wow.
And yeah, and we also aim to, you know, conduct the and invite speakers frequently, so that we can interact with others, you know, scholar and expert in the field as well.
And is the focus more academic or industry?
Both at the moment. So we, but the core are going to be academics. So we try to connect like people academically, and then we also include some practitioner in there as well. I mean, it's like kinds of you know, practical approach. Try to bridge the you know, what we done in research and how it can be applied in practice as well. Yeah. So that is like what we also trying to do is like when the time we was at the bank, right?
I mean, in a way, kind of what academia should be, not isolated, but sort of together with stakeholders, changing things.
Yeah, and in terms of the practice, in terms of the practitioner and professional and industry, we particularly focus on the financial modeling and it's like credit risk modeling like this, as you are going to present. So.
Yeah. I mean, I obviously over the years I noticed that Vietnam is pretty strong in, as you know, econometrics, but so there's a lot of good people coming out of the country.
Yeah, there's a lot of math as well. Yeah,
and then also you guys have a global spread.
Yeah, so like at the moment, quite a lot of Vietnamese scholars, they work both in academia and also in industry. So that's why we want to, you know, connect this resource and work together, learn and exchange idea, and try to improve together. Yeah.
Nice.
Right. I think yeah, we should start. Okay.
Whenever you want.
Right. Sure. Yeah, I think we're about like 50 people here already. So yeah, it's good time to start. So yeah, firstly, hi everyone. First of all, I hope that you are doing great, and thank you very much for your interest in our first webinar, and also thank you very much, Harry, for agreeing to give a talk on the very interesting topic, I must say, deep credit risks, right? But like before we start, like please let me take a few minutes to introduce about our network. Right. As you can see in our names, the Finance and Banking Network, we are a non-profit organization specializing in finance and banking under the Association of Vietnamese Scientists and Experts Global. So our network wishes to access one of the primary channels for Vietnamese scholars and practitioners to connect, learn, share, and exchange knowledge, not only among ourselves, but also with international experts as well, like many of you over here. So we love very much to connect with you, to exchange the idea, and also to get some collaborations together. So for this purpose, we have been developing multiple platforms, including research pathway. So we also conduct some research trainings, research connections activity, and we also organize research seminar, webinar like this, and educational workshop. And particularly, we host the annual conference, Vietnam Symposium in Banking and Finance, VSBF, since 2016. So this year we also have the conference we call the Vietnam Symposium in Banking and Finance 2021. So the VSBF 2021 will be organized between 28th and 30th of October, and it is still open for submission until 15th of August. So it's still like a few more days to submit. So the highlights about our conference this year will include, we allow both online and on-site presentation. The second thing is that we invite very good keynote speakers, including Professors Robert De Jong in University of Kansas, USA. He's the co-editor of the Journal of Money, Credit and Banking, and Professor Harald Una from University of Maryland, USA. He is the managing editor of the Journals of Financial Service Research. And secondly, we also have organized the editor session with Professor De Jong, Professor Unas, and also with Professor Jonathan Barton, editors of Journal of International Financial Market Institution and Money, and also Financial Research Letters, among many others. And we also include Professors Cheng Phiu Lee, editors of Review of Quantitative Finance and Accounting, in the editor session in our in this year conference, the SBF. And to make our conference even more attractive, we also provide many publication opportunities with the special issues of Financial Research Letter, Economic Modelings, and Research in International Business and Finance. So please check out our VSBF 2021 website for further details and the submission guideline. The link will be provided in the chat box soon by one of our members. Right now, let me start with the webinar. So do not waste your time more, and we go straight away to the webinars that's presented by Harry. But first, let me introducing to you Professor Harry Sut, our speaker today. Personally, I have an honor to be a mentee, a colleague and a friend of Harry since 2015. So that is my great honors and my great pleasure working with Harry for since 2015, many years already. So Harry is currently a professor in finance at University of Technology, Sydney. He specializes in core banking system, credit and liquidity risk, housing finance, insurance, machine learning, regulations, securitization, and structured finance. He is a strategic partner for banks and regulators in Asia, Australia, Europe, and North America. He has influence with financial institutions that have applied his work to improve their risk management practice. His award-winning research has been widely cited and published in leading journals, and he currently serves on the editorial board of the Journal of Risk Model Validation. Harry is also a very dedicated educator who consistently receive excellent student feedback, and his PhD students have produced impactful industry research. Harry textbook on the credit risk analytics are used around the world in the data analytics courses. And one of the information over here is that I also use Harry book in my teaching as well for the course called Advanced Risk Analytics, and also for the Risk Analytics course for both undergraduates and postgraduates. So now please join me to welcome Harry with Deep Credit Risk Machine Learning in Python. All right, the stage is yours. Thank you very much, Harry.
Thanks, Hung. First of all, thanks, Hung, and your peers at the AVSE. It's a great network, a beautiful conference. So we have had papers presented in the past, and the lineup is also very impressive with Robert De Jong and colleagues. So it's a growing network, and really good things come out of it. So, and I also like the touch you have, sort of bringing industry and academia together. So we need more of that, because both working in the silos is not good. And so with that, I didn't really want to give a paper presentation, which is common for our background being academics at universities, because I thought the audience is broader than that, and also we have people joining today with lots of ambitions. So we have people who are we're all interested, we share common interest, maybe in data science, maybe in finance, maybe in risk management or modeling. but we have a very heterogeneous group today. And so I suspect, just from the vast amount of registrations that this event has attracted, that a lot of people are interested in things like Python, machine learning, perhaps credit risk analytics. And so we bring them together. But with that, we only have an hour or 2 hours. I don't want to really go into the nitty-gritty details. So I want to talk about concepts and what's really matters in this sort of intersection. And, you know, with that, let's get started. It is a webinar format, so I don't see you guys. I see Hung, which is great. If you want to ask questions, maybe you can put it in the chat. Hung said he's going to monitor the chat and let me know what's going on. So feel free to put everything in the chat that bothers you or you would like to have an answer, and we'll try to address it if we can. Yeah. I also need to say this work that I'm going to show you might be interesting for many reasons, either because you work in industry, because you do it in research, but also it's really important that we bring this material out into the teaching space. And so starting from the PhD students to the honor students, to the master students, to the bachelor students, it's maybe you find some elements today that you could apply in your courses, and that would be also a great outcome of today. Much of the work that I'm going to show you is not my own work. I've contributed to that, but it's a work of a larger network, and also a call it another very in my research life important academic, that is Daniel Resch. And Daniel and I, we have worked over many years in the area of credit risk, the modeling for research, but also for industry models. And he was my mentor when I was doing my PhD and thereafter. So a lot of the material is based on Daniel's work, and he's a professor of statistics at the University of Regensburg in Germany, a beautiful city too. So with that, let's get started. I see there's things coming in through the chat, so I'm not looking at it, not to be distracted. The presentation that you see, we'll focus on a few aspects. We will talk a little bit about COVID. I think you shouldn't be talking credit risk these days without talking about COVID, and perhaps ESG. ESG would be the other big innovation we have had. I'll expose you to Python and to data science in Python. I'll talk about the fundamentals of machine learning, that is nonlinear relationships, and also about the issue of bias and variance, underfitting and overfitting. Then we'll talk about how to manipulate results with data. And last but not least, I'm going to benchmark 2 machine learning techniques so that we perhaps get a feeling of what machine learning can do for credit risk, but also in other areas. Let's get started. The current situation, and so I'm speaking from Sydney, Australia. I'm sitting in my office. My family's around me. Everyone's at home because we're in lockdown. And this has been the situation for many of us in the last 2 years. And with that, a lot of things have changed. The way we define work, the way we work, what we spend our money on. And so a lot of things have changed. But not only for households, but also for companies. Companies have changed the way they process, the way they receive factors into their production processes, the way they sell their products, ship their products. I think the last 2 years hardly ever was such a major period in human life where things have changed so dramatically. Of course, there were other episodes, but I think the speed with which things have changed in a very short period of time makes the current situation very unique. And it's not necessarily all bad. And credit risk is a very good example for that, because when COVID started, say early last year in 2020, the notion was that especially credit risk and credit portfolios would become very distressed. And a lot of banks worried, and effectively they ramped up the provisioning. They tried to preserve capital through cutting down dividends. And also, if you did do work in credit risk in banks, you would have had one of the busiest times in your life. There were loan deferments that were mandated by governments, where people had to manually override systems that did not had that concept of loan deferments embedded. People had lots and lots of modeling issues. Now, with the stepping in of governments, that is governments increasing their spendings through salary payments, helicopter money, or providing all sorts of subsidies to households, companies, that downturn, that perhaps adverse episode in credit risk has been avoided. We're back in happy days. Today, the risk or credit risk is at historic lows. I recently saw a presentation of an academic who summarizes risk outcomes, and he said, if you look at bond default rates, they are at current historic lows globally. And so effectively, there's no credit risk, so we shouldn't worry. But I only can caution things move in cycle, and perhaps the government expenditures have just postponed what we might have seen last year by some period of time. Okay, there is clouds darkening, and where Hung sits in New Zealand, there were the first announcement last week made by the Reserve Bank of New Zealand, putting spanners in the wheels of banks, effectively mandating banks to lend at lower loan-to-value ratios of, say, 60% for investor loans. The Australian regulators now following and thinking about implementing similar action. And usually there's a chain from New Zealand over Australia, over Asia to Europe and North America in terms of regulation. New Zealand usually regulates first because the banks are not New Zealand based, they're Australian. It's always easier to damage an overseas industry. Australia follows because they see themselves at the top of regulation, prudential regulation in banking. And the Europeans, Americans often follow because they want to safeguard their borrowers, the manufacturing companies, because they live from producing goods the rest of the world consumes. And so perhaps what we saw last week starting in New Zealand may trigger through. We will see perhaps increased loss rates going forward. And there's a lot of things that come out of this discussion. And it does not necessarily mean whether we are at high or low risk. It matters more, how should we model risks? And across the world, we have two situations. We have countries like Europe and North America that has abundance of loss information because they have gone through economic downturns where loans default. And in particular, the global financial crisis has led to huge data collection of losses. Asia and Australia, New Zealand, we sit on the other end. We have had growth periods ever since we started collecting loss data or default data. We have very few default events. We know very little about what happens in the case of default, just because we were in very benign, very positive economic periods. And so I just want to highlight that there is two parts of the world, people who have a lot of lost data and people who don't have a lot of lost data. And the modeling approaches people apply might differ between these two groups of people. And so coming from Australia, where we don't have much lost data, people are much more trying to get to how bad could it be in economic crisis by building models for economic crisis without having any reference data in the data sources. And so we work a lot with concepts like margin of conservatism, Bayesian approaches, where we basically take the current low level of default rates and try to extrapolate these two crisis periods. On the other hand, Europeans and Americans, they have lots of lost data, and they often basically can just subsample. We can just say, oh, let's take the global financial crisis with a couple of years and look at how bad were the outcomes of risk in those years. With these sort of rich databases, you can do stress or scenario-based stress testing, and you can also build much more complicated models, such as regime switching models. And the outcome of these two worlds we see in many cases. So if I look at, as an academic, at the literature, I mainly see European American studies. Why? Because the databases in Asia and Australia are not good enough to provide models that are meeting academic standards. And so if I was to estimate a model based on Australian, New Zealand data, very quickly my peer referees would turn down these models and saying, but how general are these models? Do they really reflect what's going on in economic downturn? We don't know. Last downturn in Australia was in 1991. And in 1991, we did not collect data, either that is public or private within the banks, for this building the models we could build. And so those issues, I think, will become an issue. I think COVID may still result in larger loss rates. And then if that happens, we are just following, we always just building models on the past observations, but wouldn't it be great if we have models that actually predict what's going on in the future before being exposed to it? I also want to highlight there are two big dimensions, and we'll see that in our talk later on. Credit risk, the big drivers there are liquidity and equity. Regardless of whether you talk about corporate lending or mortgage lending or any other form of consumer lending, any credit risk model should include these two dimensions. And at the moment, COVID has an impact on these dimensions. So we talk at the moment about the government spending, the purchasing of the bonds that has led to inflated asset values. And inflated asset values effectively has increased equity. Equity values, being it on the household level, on the corporate level, it sort of suggests very low risk. Why? Because the so-called loan-to-value ratios, collateral ratios, they are very, very, very low, and indicating collateral ratios are high, but the loan-to-value ratios are low, indicating very safe loans. Obviously, to the degree we talk about asset bubbles and burst of asset bubbles, that may not hold. And second, when we talk about liquidity risk of borrowers, there's also currently the concern that one of the many expenditure items of borrowers clearly is the interest payment, the servicing of the loans, that as inflation rates and interest rates one day will move up, and they have moved up already outside the central banks through secondary markets, bond markets, for example. We talk about bank funding costs and banks passing on these increased funding costs to borrowers. The rising interest rates on the borrower's expenditures will cause further distress servicing loans going forward. Yeah, and so those are all outcomes where COVID, even though everything looks very rosy, very positive at the moment, very quickly can move into a different direction. And for us, credit risk modelers, events are actually good. Whilst banks are losing money and all that, it's not a good outcome. But for the for a modeler, any additional observations we have on these default events is a good outcome. Should also highlight there are other dimensions, for example, time effects. We are working actually with Hung on one of these problems. There are different time dimensions, not only about the macroeconomy, it's also about age and vintage effects. Let me just pick one, the vintage effects. We've discussed that the abundance of money in the financial system has led to loosened lending standards in the banking system, and that usually suggests also an increase in risk in future years. And last but not least, just the economic cycles that I described being ups and downs, they cause challenges on the machine learning field, because effectively we are training machines on economic episodes. And we are using these machines, again, mainly not to forecast individual outcomes. A bank doesn't care so much whether a mortgage loan defaults. It worries more so whether the millions of loans outstanding, whether a significant fraction of these loans default. And with that, the testing of these models or the application of these models out of time, out of sample, to other economic regimes and periods, that is a huge challenge for any modeling exercise. And so I'll be also talking today a little bit about the validation of models. Okay. Do you have any questions on COVID and the impact on credit risk, or are we all good?
Harry, we just got one question. Whether you can provide the PDF of the slide later on.
Okay.
Yeah.
No. So the answer is No, because it would cause a bit of work on my end. And not because I'm a lazy person, but I'm going to show you why. The slides is not in PowerPoint. The slides is what we call a Jupyter Notebook. Jupyter Notebook is a IDE that integrates with Python. And it's a bit harder to do it in, it's an HTML format. It's a bit harder to move it into a PDF. So I can move it in PDF, but there are different dimensions and I have to store them separately, but it's going to confuse you. But I know Hung is recording it. And so with that, you can just watch the recording, if that's okay.
That's right, yes. So I also give the answer like that. So the webinar today is going to be also recorded and posted on our YouTube channel. So everyone who wants to review it can go back to the videos on the YouTube, on our YouTube channel later on. Right. Okay. Thanks, Harry.
Beautiful, but yeah. So definitely watch the video, but also you know, what I'm going to talk about is things we have summarized in the book. And so now a bit of advertising here. That is the book. It's called Deep Credit Risk: Machine Learning with Python. And so what I'm covering today is a very tiny fraction of the concepts here. So we talk about maybe 10 pages in 500. There's so much more in the book. So to the degree, you know, you want to dig deeper, I strongly recommend get an ebook or the physical book. Or if you can't afford it, it's not very expensive though, but just ask your library to buy it. Every university library in the world should have it. Okay, so but what the book does is, so it's a new way of teaching. So we have this traditional textbook character, but it has, if you open it, let me just open a very example here. It has in there a code, an output, and text. And so the book front to end is written in Python, and every single example that you see in the book works because the machine has compiled it. There's no room for errors. And unlike other books, there's not just a formula. There's actually the code that supports everything. And what you see can be reproduced. Further, you can download the data and the code that underlies the book, some of the code, but all the data on deepcreditrisk.com. So you go there, you just download the data, and then you can basically reproduce all these examples using Python. There's also tons of videos. There's a YouTube channel if you want to have a look at some videos. There's a video that helps you get started installing Python, for example, if you're totally new to the game. And then there's little videos that take you from one level to the next level. Check it out. So all you need is basically, you just go here to this website. I'm not sure whether it works. And then you either follow here for the data and the code these prompts, or you download or look at these videos, okay? There are also other resources, yeah. So like academic papers we've written, and you know we keep adding as new stuff comes out to these repositories. Now, after you've downloaded the data and the code, now the data what we're looking at is mortgage data for the US, and it goes from the spans over the periods 2000 to 2016, so it's fairly recent. And most importantly, it covers the downturn experience in the global financial crisis, where loss rates in the mortgage industry in the US, but also other countries, went up by multiples, okay? And now, before I get deep into detail, I want to also talk a little bit about Python. So as we analyze data, we use programming languages. There's a whole large suite of languages, and they all effectively do the same thing. So if you run, for example, a linear regression model on the data, in all the programming languages, you get identical outputs. But that said, if you then move on from linear to nonlinear regression models to perhaps machine learning techniques, which are more recent, and as we speak of new developments, you find that languages often provide a little bit different degrees of functionality. And it is actually machine learning, and in machine learning, it's the area of credit risk that has probably helped the evolution of one language in particular, that is Python, the most to get a significant market share. And there's this discussion, which language is better? I can only say I've studied over the years a range of them, not many, but EVSE literate, Stata literate, MATLAB literate, SAS, R, and Python literate. And out of all these languages, they're fairly similar, even in the setup, except I noticed over the last years that there's a drive towards Python. And we speak to a lot of users because we have written similar books in SAS and R, but we've spoken to users in many different countries, and it's a bit regional. In the US, it's clearly all the industry players, all the bankers, almost all move to Python. In Europe, it's a little bit sort of a mix between SAS, R, and Python is up and coming, but even SAS and R, I would say they're more dominant. In Asia, it's, I find all the languages, although in Australia and I find a little bit sort of R being a bit more popular with the community than the others. But those are data points, and you might have others and you disagree. And it doesn't matter because they all are very similar in concept. You know, it's like many of us, these languages, they are not developed in isolation. They actually copy and paste from each other, you know, to some degree, or, you know, if something is successful, then we quickly implement it from other providers too. Now, what I would say, having worked with all these languages, that I find Python the most intriguing one, even though my roots are in SAS. So I started off 20 years of SAS modeling, and now I had to change. And, you know, there's a bit of work involved if you want to change, but Python allows a lot of things. It allows the integration with the internet a lot, so HTML in particular. And also Python, it turns out it's kind of the majority wins. So as I wrote this book, my son, he's in year 7 now. Back then he was in year 5, walks into my door, this door behind me, and he looks into my screen and says, Dad, are you doing Python? And I said, yeah, shall I show you a few things? And then he said, no need, Dad, I already know Python. Turns out in New South Wales, in Sydney, Australia, primary school kids learn, not much, but some Python coding in primary school. And, you know, they keep going in high school, they do it as well. And by the time they reach university, they have quite a good understanding of the subject matter. Now, the other beautiful thing in Python is it comes with many IDEs. So if you talk about SAS, MATLAB, R, usually people use a particular IDE. In R, it's called RStudio. But in Python, you can use many. And some people use a Spider, others use, in this case, it's Jupyter Notebook. You can choose the IDE that suits your needs. And my son, he didn't use Jupyter Notebook as Spider in school. He used a particular IDE that's made for primary school students that makes it much easier for them to understand the matter and just focus on what's really important without too many links and buttons, and just a bit of even a lot of helpful tools. Now, either way, you have a box in all these languages where you put in code. And so what you see that now is now the box where I put in code. And the way we start off, we bringing in the code, and we have created, it's called a package or a function. It's called a module, but it's a combination of multiple functions. It's the DCR module. And what we do is we just import it into our system, and not much is happening. But once this is executed, what it has done, it has imported a number of packages that we require. I'll show you a few. And it also has imported the data. Yeah. And so we can look at the data either by looking at data, or some people, use the print command, which has a slightly different format, but it doesn't matter. So we just look at the data, okay? And so now what we are looking at is a traditional credit risk data set in the mortgage literature, or in the mortgage, call it risk modeling discipline. We do have the first column, that's the index. The index is just a number, and there's now a difference in syntax. I just throw them little by little in. Python works off zero-based indexing, so any sort of numbering starts in Python always with 0. Then the second column here is, for example, the loan ID is just an identifier for the loan. And we have here a number of 4s. That just means our first loan has the ID 4, and we have multiple observations because each row is a different observation. We have a number of timestamps. It turns out we have in this data set 5 different timestamps. So a lot of the econometric modeling does not measure only time as we think of time. It matters fundamentally in the risk analytics what sort of time you look at. You look at the observation time, the origination time, the first observation time, maturity time, and also in risk modeling, when we talk about loss given default modeling, we have this concept of resolution of the workout processes. So only here we have 5 different timestamps, and we can compute, differences between times. We can do all sorts of subsampling and clustering exercises just with these 5 variables.
Yeah, can I have a question over here from Carlos? Asking, is the panel's data frame?
Yeah, so first of all, what we see here is a panel, and in Python, and now this is very Python specific, there are 2 main, call it worlds or packages where people analyze data. The first world is NumPy, and the second world is pandas, as Carlos has suggested. Now, what we currently look at is pandas. And when we later move on to machine learning, a lot of people move to NumPy. So much of the machine learning is based on NumPy. Yeah. When it comes to Python and Python modeling in industry, you're most likely to need both packages, because pandas has all the panel data, time series, transformations. For example, you can easily match merge data sets. You can introduce lead lags. You can, compute returns of that. And so there's a lot of functionality in pandas. And so pandas are effectively enhanced data frames, enhanced arrays, whereas NumPy effectively just multi-dimensional, call it arrays. And you have multi-dimensions, okay? But there is not this notion of, this is an observation, this is a column that stands for a variable. So in daily work, you most likely need to pandas, so data science work. But when it comes to machine learning, things that are repeatable, executed by machines, most of that sort of works in NumPy. Yeah. And I'll show you both. As a matter of fact, this is pandas. And I think if you just add the values command, then you convert the pandas data frame into a NumPy array. So this is how a NumPy array looks. But clearly, for someone who's starting data science, Python coding, NumPy is a bit hard. Because suddenly all the columns have no values anymore. What do they mean? Who knows? And there are lots of rooms for bugs and errors. That's why for now we just stick with pandas, so that we have variable names for columns, and we can imagine a little bit more what's behind these numbers. So for example, after the timestamps, just to keep going, for example, we have the loan balances. So we know the amortization profiles of loans. We, for example, have the loan to value ratios in percentage points, the interest rate in percentage points, and so on. Okay. And we'll look a little bit more at the data, so just stay tuned. Now, also we have, by running this code here, the module DCR, we have imported packages. So some are packages that others have created, things like pandas. The major ones we use is pandas, NumPy. We use a scikit-learn for machine learning. There are then a few minor ones. For example, if you want to do survival analysis, you need a package called Lifelines for survival analysis. If you want to do certain plotting, there are different plotting packages and so on. And we have brought everything already in our system, so we don't have to do all that installation ourselves. Yeah. And on top of that, we have also imported a number of functions that we've written to promote data science and credit risk. And so I would say the one that I think people who work in that field benefit the most is going to be the validation function number 4. But there are other ones, for example, weight of evidence, resolution bias, data preparation, the version function that help you working with Python in credit risk. Okay. I'm going to show you a few, so you get a feeling for that. So, and the data set, just maybe to expand a little bit more, has different parts called themes. So we have the ID variable we have seen. We have the 5 timestamps. We have information that is measured at loan origination. And we have information that is measured at loan observation. And then we also have outcome observations. Now, a bit of lingo, when we now move into a world of machine learning. People in machine learning, like people in regression modeling, they try to connect dependent and independent variables, y's with x's. And the y's are called outcomes. So they're usually the left-hand side variable. And the x's are called features. So you find, because Python machine learning is very engineering infused, people no longer talk about dependent, independent variables. They talk about outcomes and features. But the same thing, it doesn't matter. But the point being now, our features are going to be information measured at loan origination and at loan observation. The reason for this distinction is banks, when they make like lending decision, they collect most information when they make the first loan. So because there they have a bargaining power chip, because they can say, oh, you give us all the information or we don't give you a loan. And so they are able to collect a lot of information, especially from households. They can collect pay slips, they can collect expenditures reports, they can collect all sorts of information thereafter. But the moment the loan is out the door, at observation, it's much harder to collect information because the borrower knows he has already spent the money. The risk is now for the bank to recollect the money. Covenants are usually very non-existent in consumer loans because governments don't allow them, or they're very weak for the corporates because it's very hard to measure. And so with that, we have most of the information upfront, and we collect a little bit on top of that during the life of a loan. And then last but not least, outcomes. The outcomes for credit risk analysis, usually the default, non-default event. We speak of probability of default models, or loss rates given default. We speak of LGD models, or exposures for the outstanding loan amount. We speak of exposure models, or so-called refinance models, because banking, like any other industry, is subject to customers changing providers. So if you're a bank, say Westpac, and you're lending to one borrower, the borrower at any point in time can change to a different lender through a refinance transaction. And governments strongly support refinance because they want to ensure banking systems are competitive, and borrowers, in particular household borrowers, are not locked in for 30 years to service a loan with a chosen lender. So with that, turns out actually the biggest activity in our data set, and we could show that, it does not necessarily come from a default. It actually comes from refinance and paying off a loan prior to maturity. And so this is the same if you're a telecom company, say Vodafone, and your customers walk to competitors, say O2 or Telefonica or whatever other providers are. And that also is exists in banking. And all these outcomes, be it a default, be it a maturity or a payoff, they effectively have consequences, financial consequences to the banks. I don't want to go further. We don't have time for that. But I could spend days and days to talk about refinance and payoff, because next to default, that's the other very exciting area. And we do have at UTS a PhD student. Her name is Mai Luong. She might be even here today, who's an expert on payoff and refinance, if you want to contact Mai. Okay, so now let's talk a bit more about Python, and then we get really started. So here, let me just maybe tell that in steps. We said, okay, we can look at the data, but just looking at the data, we write the data, the name of the data set here, the data. So that's the name of the object that carries the data frame in pandas. And we can also create slices of that data. So for example, we can create a slice with a double square bracket. And if you are interested in just extrapolating below an ID, we just say in 2 square brackets, we want to look at the loan ID. Okay, and now we just cut out from the whole data set the index, that's the left column, and the data, the ID variable. We can also look at ID and FICO score. And then we get 3 columns. Now, one important thing in Python is it's case sensitive. So you cannot just replace ID with capital letters. Nothing will work. Now you get an error message. And so you need to be always aware that the syntax is case sensitive. You can use upper and lower case letters, no problem. You just need to know what you're doing. use our lower or uppercase. And that holds for variable names. It holds for object names. It holds for, functions, packages, methods. There's all sorts of elements that Python uses. It's always case sensitive. Okay. Then Python, another important concept is Python lives from chaining. And so, for example, if I wanted to, from that column, let's focus on one, that is the FICO score, it's a credit score. If I just wanted to get descriptive statistics are things like mean, min, max, percentiles, then I can chain as a link. I can chain a method that is something that I want to do. And for example, what I want to do, I want to describe that variable. And I just chain with a dot the describe command. Okay. And then I get a distribution, an empirical distribution of FICO score. That's great. And of course, if I wanted to, for example, round, then I can use the round method. And for example, I can round to 2 decimals, and I can execute that as well. Okay. Execution, like in many programming languages, with Shift Enter. And I can do that. I can also do that for multiple variables. For example, for the loan to value ratio at observation time, I can do that as well. And so when I build my tables for the analysis, and what that tells me is the average credit score is 673, the minimum is 429, the maximum is 819. There's a lot of economic content in these values. Okay. Any comments so far?
Harald, we just got 2 questions regarding to like the reason why Python are often used in machine learning in terms of credit risk modelings. Like why not use PERL for this for credit risk? And the other question is like what is kinds of like liquidity that you are referring to? This include buildings, house, and land included in there?
Yeah. So first, let's do the second question. So liquidity, we haven't really computed liquidity in our data set yet. I could talk about it, but it would expand my time frame here. But if you go to the book, there's a section on liquidity, and it looks, this section look at loan balances. And so you could construct a liquidity measure by looking at loan balances. Other measures in banking don't look at levels, they look at flows. One of the most important flow variables would be the debt to income ratio, DTI, it's acronym is. And so there are many concepts. And so liquidity itself is a discipline. So people spend their whole lifetime, or they can spend their whole lifetime, and there's actually a few of them, just worrying about liquidity and changes in liquidity, that is liquidity risk. So currently, we don't have anything for liquidity, but we will construct it. I can later show you where. But for today's session, I just let the function that I've shown you earlier compute it for us, and I tell you what's liquidity. You need to believe me, but clearly, if you had more time, you self-compute it. Yeah. And now the other question: now, why not other languages? Why Python? Why first of all, there are surveys. What are the most important languages? And these surveys usually show the dominance of either SAS, R, or Python for data science. It's regional, and it also depends on who is sponsoring the survey, as always. Turns out there are some surveys who come with other languages, which usually financially supported by the providers. But even in countries that you think, why? For example, China has Chinese characters, and maybe they have the ability to create their own languages. Even there, you find that Python, R are very strong languages. We talk about a market share. Both of them have about 50% market share. All the other languages are not Chinese languages. They are often also Western languages. And Perl is one of them. And I don't know. I've had people suggesting Perl is the next Python. So I think it's about perhaps it's about the market share, what people are most using, because just to even to set up a data set, to process it, you need the reference points. And with the larger languages, you have lots of manuals, lots of help, lots of guidance. And very quickly you run into problems, because we work on different operating systems. We work on different browsers. We work on different versions. And very quickly deploying machines and programs becomes super, super complicated. And when it comes to credit risk modeling, I would say 80% of the credit risk modelers globally, maybe even 90, are sitting in banks, in institutions. And they have no choice what language they use. It's given by the team or by the bank. And so they need to use what the bank has a license for, what the bank is comfortable to use. Only 5 years ago, Python and R would have not been used by most banks, because they said it's not, there's no provider that you can take into recourse if something goes wrong. For example, SaaS, you have the SaaS Institute. But here in Python or R, you have the crowd. No one's going to pay you if something goes wrong. And even in our book, when we wrote it, every language has new versions coming out all the time. And very quickly, your number's going to change a little bit. Why? Because there's some package that's wrapping another package, and the other package just discovered a bug in a certain line. And if you're a bank and you have calculated all your loan loss provisions using that procedure, and now you have to make a loan loss provision adjustment just because there was a version by some geek sitting somewhere, you cannot justify that to shareholders. You need to be fairly confident that every time you run the program, you get the same results. Of course, you can manage that. You can introduce versions in so-called environments controls, and banks do that. And so these days, most banks have environments where they know which program version they use. They are open to open source languages, but to a degree, you move now to languages that are less common, things like maybe Perl. You have a hard time finding staff that's literate in that. But also there's less confidence by big banks to deploy these programs in the organization. And I had the discussion on that by one of the major banks in Australia a few years ago, 2 years ago. And they basically said out of 20,000 employees, about 5,000 employees were Excel literate, Excel. And 250 employees were so-called SaaS R Python literate. And only 6 or 7 staff members in the organization were probably on the level of Perl and above. And not even Perl was mentioned as a reference point. It's just advanced. So with that, explains a little bit what's going on, but it's only based on anecdotal evidence. But a very good comment. Yeah, and so I just want to say one thing again between SaaS, R, and Python. They all have the same, I would say, procedures. The syntax is different. The good thing about Python is it's very homogeneous across implementations. So, for example, if you estimate one machine learning technique and another one, often the syntax does not change. So you only replace a single word, rerun the code. Versus SaaS is a bit different because SaaS has a legacy system where we always bolt on a new program, and over time the syntax changes. And so, for example, in SaaS, the syntax, because it's a much older language, or a little bit older language, you find that the syntax between the techniques, the machine learning techniques, very different. And then the other aspect is SaaS is good at selling. So they often ask you to subscribe to different packages, and you don't usually have access to the whole universe of methods, versus in Python and R, it's just a matter of downloading what you're after. Okay. Now I want to talk about a little bit about nonlinear transformations, because machine learning lives off that. And so let's pick one variable. This is the loan-to-value ratio. Loan-to-value ratio is a key driver in credit risk. It is the proxy for equity, or 1 minus equity. And I just want to, what I do here in Python, very quickly, I form categories. I form 15 categories. I use the method QCut. So I form 15 categories of equal number of observations. Why 15? It doesn't matter, do it with 20 or 10, same observation. I can get the boundaries which are chosen, and I then create a new variable in my data set that has the category in it. Yep. And then I compute, let me just show you that so you know what's going on. And I can plot here the data set, and it has now created here a new variable, which is the category 0 to 14, 15 categories, zero-based indexing. And also what it has created is boundaries. It gives me the class thresholds. So basically the loan to value ratio from 0 to 46 is class 1 or class 0. From 46 to 56 is class 2, class 1, 56 to 63, class 2, and so on. Okay. And then what I'm doing is I'm just calculating the mean loan to value ratio and default rate. So the default rate, the mean over the default indicators for that data set. And so the new object or the new data set I get has as an index the number of loan to value categories, the average loan to value ratio, and the default rate that's observed in the data history. Okay. Then I can plot what I've just computed. Generally, we have huge databases, and the issue is if you want to plot something, you need to aggregate the information. So in this case, we just want to show the 15 data points. Let me just make that a bit smaller. And what I see here is now on the x-axis the loan to value ratio. That's the call it the debt funding of a loan, and the default rate. And I hope this works. So if I annotate, you see here 3 regions. So usually below 80, you find a very flat risk insensitive region of the loan to value ratio. Then between 80 to 120, you find a much more sensitive region. And maybe here, who knows what's going on? Maybe you find a flattening out of that relationship. But you can see in that relationship of that feature versus the outcome variable, you find 3 different regions. This is the start of thinking about nonlinearities, because pretty much every variable you can think of features nonlinear. And you know, finance is a very, how shall I say, innocent discipline, because we do a lot of regression modeling, but very rarely we look at nonlinearities. We just look at beta. Is a beta positive or negative, and that's it. But really, most features are nonlinear. This is loan to value. I could do it for liquidity. I could do it for all sorts of things. The reason is the thresholds. And you know, here, just to have a few thresholds in there. And you know, here this is usually the lending threshold. Banks tend not to lend above a loan to value ratio of 80%. This threshold here is the underwater mark. Banks, when you're reaching an LTV of 100% go above, you have negative equity. So you have structurally, call it broke. And yes, maybe the default increases here, but here maybe those people have already defaulted, so it doesn't go further. Yeah. So there's a lot of economic content in the nonlinearity. And until a few years ago, pretty much with the evolution of R and Python, people didn't worry about nonlinearities and outcome R and Python, and suddenly people are estimating techniques, neural networks, random forests, SJB, and so on, which have been out there already for decades in some cases. But we'll see later, they have the benefit of modeling some of these features. Okay. Let's just now move on. And you know, this is not only about machine learning, because what you can do is let me just stop that. Okay, go move on. What you now can do is, in econometric regression models, you can include nonlinear features. So what options you have is you can put in polynomials. What polynomials are is effectively the feature itself, the feature square, the feature cube, feature to the power 4, and so on. You can put in splines. Splines are also effectively similar to polynomials, but the way they work is they look at intervals, for example, like what I've just said, between 80 and 100. So up below 80, 80 to 100, above 100. And then they estimate separately the regression for these regions and make sure that the implied or the fitted estimates sort of sit next to each other at the threshold. Okay. And there's absolute and relative spline coding, and it's all in the book, But for now, I just want to make one point here. There's different techniques: polynomial, splines. You can put in the categories in your code, or weight of evidence. Weight of evidence is an old concept, but it's still applied. And all these concepts with normal regression models are able to model this nonlinearity we have observed. Now, that said, the nonlinearity for polynomials, if you just look at here, your model is the solid line and the outcome is the dot, the scatter, is not perfect. There's a deviation. No? And so there's a deviation in splines. So these fitted and observed, they're not always identical. And same for categories. But for categories and for WOE, for categories in WOE, the match is perfect. Okay. So in the top two charts, we have an imperfect match. It's good, but not perfect. And at the bottom two charts, we have a perfect match. And now what's the difference? The difference is, in this case, I haven't told you how I did the polynomials and the splines, but we have 15 data points. Remember 15 data points? In the top two charts, what I've done is I have included 3 degrees of freedom, we call it. So I've included a polynomial of degree 3 or a spline term that has 3 sections. And in the bottom chart, what I've been doing, I've just used the 15 categories to have category implied default rates, or I've calculated the weight of evidence for each one of these categories. Now, in the bottom charts, I have a model with degrees of 15. And if you have 15 observations and degrees of 15, of course, you have a perfect match. So what we see here, the technique, the number of parameters you put in gets better and better if you have more parameters in it. And obviously you have a perfect match if you have the number of parameters of the number of dimensions or data points you look at. And the same now holds for machine learning, because in machine learning, and today we will not become experts in machine learning in terms of the implementation. I would need a whole class, perhaps a couple of classes, to make you literate on that. But I can show you concepts, and these concepts apply for various techniques. Yeah. And so machine learning models achieve the same nonlinear fit for different approaches. So one class, for example, neural networks, and work with hidden layers and activation functions, that is link functions between the outcomes and the features. Decision trees work with a splitting of a feature space, where you say, for example, loan to value ratio above and below 80. In random forests are bootstraps, that is random samples of decision trees, which you then aggregate later on. Okay. And so there's more machine learning techniques out there, and they all have their way to fit the data, to fit the model to the observed data. Yeah? And effectively, what they are doing is exactly what's going on here. And you can actually, in many of these techniques, decide. Random, for example, you can decide how many bootstraps you want to run. You want to run 2 or 100 or 1,000. And these parameters called hyperparameters in machine learning. And here we have just used our existing regression models, in this case, well, a Logit model, and we have used here, call it a model of complexity 3, and here a model of complexity 15. And so the same can be done in machine learning. Okay. I will stop in a minute, and then we can maybe go through all your questions. I'm sure you have many. it's just the following now builds on that. So let's quickly finish that, and then we go to all your questions. And so now,
thanks a lot, Harry. Yeah.
Yeah.
And would you have time to answer a question?
Okay, then we do now. Yeah. No
problem. Okay. Or you can do it later. No problem.
Yeah. Just okay. That's fine. Let's do now.
There's 4 questions over here. The first one is, can you share some advice on how to handle missing data before modeling?
Yeah. Again.
Second. Yeah.
Sorry. Yeah. Keep going. I'm making my notes.
The second one is, would that perfect matching would not be a risk to be overfitting the data? So let's go with the 2 questions first, and then later on we'll go with the others. So the second one is like the overfitting problem.
So the first question, missing value, sounds easy. And, you know, we academics, we always say, missing value, just replace it with a cross-sectional mean, or just kick it out, use a drop NA statement. But it's actually more complicated than that. Missing values are probably the most underestimated feature. So because in missing values, you have information. Often there's a reason why the value is missing. If it's an error, okay, it's an error, kick it out. But the missing value might actually be a reason, an economic reason why it's missing. And so for many, many applications, missing values actually should be the center point of your research or of your model building. And so this is where the problem starts. If you then acknowledge our missing value stands for something, then how do you treat it? In the book, we have a whole section on missing values, but we only, again, this is say 20 pages, it goes in the right direction, but there could be a lot more to be done on missing values. Second question, overfitting, is coming in a slide, so if you bear with me, but you're correct. If you perfect match, you overfit. Yeah, so spot on. Yeah, and so with that here is exactly the point. Now we can decide how to build the models, be it on ordinary econometric techniques or machine learning models. We can say we want little complexity or a lot of complexity. Now, if we have little complexity, then we have a problem which is called underfitting. We introduce a bias. Our model does not describe the data well. However, if we do too many parameters, it's exactly what I think was it Carlos was saying. The problem with that too many parameters is that we are overfitting. The data fits our sample perfect, but the model is not general enough. If we apply that model to another situation, be it another time period, another loan portfolio, the model does not predict well. And give you an example. One of the key models in credit risk modeling is the Merton model. So, you know, we always like to cite the Merton model. It's a model for probability of default that's based on the Black-Scholes pricing framework. People got the Nobel Prize for it. And we think it's a cool model. It's a cool model. But effectively, it's very prescriptive. It's very overfitting. It is, perhaps, given all the assumptions, it's the right thing to do. But if you apply that to any credit portfolio, the deviations between your fitted values and what you observe are so stark that it would not pass internal and external validation of the banks. Yeah, and so we have worked for 20 plus years in this field. We have never ever seen the Merton model applied in industry. Or to even get one step further, the Merton model is implemented by KMV. I have not even ever seen the KMV model, that is a calibration of the distance to defaults to observe default rates, applied in industry. I hear some people do that, but I have not seen it. Okay, and so, but there's many more examples for overfitting, and let's look at a few. Okay, and so I just want to highlight there's also a third source of error, and that's irreducible random error. And you know, this is a bit debatable. Imagine you flip a coin. We know heads and tails have 50% chance, but the outcome head and tail is hardly to predict. Some of us, we are usually statisticians. We think the best you can do is predict the probability 50%. Other people out there, they are scientists, mathematicians usually. They say, perhaps you can predict whether it's a head or tail, because maybe you can figure out how you flip it, and then you can look at the air and measure the air, and it's going to turn around, and maybe you can calculate everything, and you can actually predict head or tail. It depends on, so if you are a statistician, you say, I cannot be better than the 50%. If you're a mathematician, maybe you say, I can predict it perfectly. So for the statisticians amongst us, there's still this irreducible random error, but you can't provide a perfect prediction. No. For the mathematicians of you, just drop the third bullet point on the slide. It doesn't exist in your world. Now, there is this trade-off now between under and overfitting. So you make a decision, do I want to underfit or overfit? And this trade-off is usually handled with concepts such as cross-validation and tuning, hyperparameter tuning. Again, I don't have much time to go into that today. I just want to highlight that if you hear these concepts, and again, the book has a lot of material on that, 6 or 7 whole chapters on that tuning. So that shows you how to get that optimal mix between under and overfitting. But now, what is under and overfitting? And I think this is explained by an example. Let's look at these charts. So first of all, we have 6 charts. We have 2 columns, and I'm only going to focus for now on the left column, if that's okay. And what the left column has is it has the yellow line. So it's kind of, think of it a default rate over the economic cycle. And then we have the blue scatter plots. And basically the yellow line is a true data generating process. And the blue plots are the scatters, they are kind of what we observe in the data. And now we estimate a model. And for example, in this first case, we estimate a model of with 1 parameter. Yeah? And so if we do that, then we just get a slope. So we get a straight line. It's a linear model. We get a straight line to match the data. Alternatively, we can, of course, do a model with 3 terms, polynomial of degree 1, 2, and 3. So feature, feature square, feature cube. And then we get the green dashed line, which follows the data generating process quite well, but it's not perfect because the observed blue lines are still away from the green line. And then we can introduce with 20 data points, a model with 20 polynomials, a perfect fitting model. And clearly the green dashed line runs through each scatter plot. And so this perfectly describes the data. And so this is all for the trained sample in the first column. And now let's have a look what happens if you apply that model to the same experiment, but just another random draw. Okay. And then we are here in the right column. That is the second column. And basically we have the same fitted model. That's the same line as here. It's just our blue scatters have changed because we had another random experiment. And now these blue scatters are different. And on top of that, we can now calculate performance measures. And I'm choosing the MSE, that's the mean squared errors. So basically what I'm doing is I'm calculating the distance between a scatter and, between a scatter and our model. So here's the model, and here's my scatter. I'm measuring the distance, I'm squaring the distance, that's a squared error. And I calculate the average over all the squared errors. And the greater the mean squared error, the poorer the fit of my model. Okay. And so now I'm doing that out of, for a new sample, I call it the test sample. So the first of it was the trained sample, now it's going to be the test sample. And we see that actually something quite unexpected happened. The test sample turns out to have an MSE that's better in terms of it's lower. So it's not a bad model because the train and the test sample are similar. Actually, I make that statement if I was to now not have 20 data points, but I would increase the number of data points maybe to infinity. These MSEs would converge to each other. So the train and the test data would be similar. That's my guess. Now, I can go down now. And to the next setting where I estimate the next model. So the next model is going to be the 3-degree polynomial model here. And so the green line is the same as before because it's the same model, but our scatters have changed. And now I recalculate the MSE. And we see here that the MSE has changed. Let me just get the pointer right. The MSE has changed from the training sample of 7%. Again, 7% is lower than the 50% before. Why? Because we now have 3 degrees polynomial. But in our test sample, it has changed to 22%. Now, 22% is still better than 44% we had earlier, but it is bigger than the MSE in the train sample. Okay, and so long story short, as you increase the complexity of your model, the fit gets better, but we also see that the fit of the train sample relative to the test, of the test sample relative to the train sample deteriorates. And this is exactly what Carlos means with overfitting. So your model applied to other data sets suddenly is overfitting. It becomes not good enough. Here, 3 polynomials is still good because doing 3 polynomials in the test sample gives us still a better result than 1 polynomial. Yeah? But of course, then we can do the next one. We can go to fitting or providing a perfect model. That's this model here with 20 polynomials of degree 20. And whilst in the train sample, we are spot on, our MSE is almost 0. It is 0, it's just some whatever computation error in here. But if I do it now for a test sample, what's happening is not in a single instance, the green dashed line runs through a blue scatter. Here, it might look here as if it does, but turns out it doesn't. Yeah? So if what I mean here is this one. If I, for example, here, this is the line and the scatter is so close to each other that you think they are overlapping, but they're not, they're actually far away. And so we see here the MSE now shoots up from 7% to 9,000. That's astronomical. Yeah. And so within 1 to 3 to 20 polynomials, there's a turning point where suddenly your MSE increases. And the MSE, when I did my PhD and the first time saw RMSE or MSE, I was thinking, oh, what crazy number that is. But the MSE is actually a very, very simple measure. And it's actually the measure that's closest to bank profitability, because the distance between your observation and your fit gives you an indication of what wrong decision you as a bank can do in terms of the assessing of credits. And usually, if you overestimate the risk or underestimate the risk, you have losses implied. And these losses are heavily correlated with the MSE. So out of all the measures, it's not as symmetric, but a variation of the MSE is probably what's going on in the mind of banks. And so with that, the MSE is actually summarizes very well under and overfitting. Okay. And so this is the problem. And we're not even at machine learning, but it's exactly the problem of machine learning. These procedures tend to overfit. And now I'm talking to my discipline because I work in finance a lot. And I see a lot of machine learning papers coming out because it's trendy and it's easy to use existing papers, bolt on a machine learning technique and say, hey, this paper has found a performance of X, and with machine learning, I'm 5% or 10% or 100% better. You can do that for everything, for every economic relation that has ever been published. Just do it. And I see papers being published where people do not scrutinize overfitting. Yeah, it's easy. It's easy with machine learning technique, with any technique as you increase the parameters to have a better model. But that does not mean that what you're observing is actually what's going on in the data. And so this is the problem. And in any case where we use machine learning to analyze things, you need to demonstrate. You need to demonstrate that your machine learning technique provides a better fit, but also is robust. And usually you do that with cross-validation, hyperparameter tuning in certain regions. So machine learning is far more complex than just executing a line of Python code where you change the input and the feature, so the feature space and the outcomes. It is actually, you will spend much more time when estimating a traditional regression model, because you need to understand what all these parameters do and how that impacts your model results. Yeah? And also going forward, referees become more sensitive of that issue. And they will demand probably these robustness checks going forward. Yeah. Now, let's just move on. This is where in banking, what we do is in credit risk, we split the data not along the cross-sectional, but we split it along the time series. So that is, we look at different time periods. I'll show you that in a second. Either way, whether you look at econometric techniques or machine learning techniques, you can manipulate them, the results. This is how it works. I hope basically what is you can state your hypothesis after you analyze the data. You can test multiple times. You can include different features until you find that feature combination that supports what you're after. Or you can selectively report, of course, then if you have multiple results, the ones that fit you. With machine learning, you can do the same thing, pretty much what Carlos has described, or we showed earlier. You increase the number of parameters, and then you find a very good model. Both p-value hacking and ML hacking result in overfitting. Now, I just want to show you a last thing. Now let's have a look at machine learning techniques. Let's first look at the data. So in the data, if I calculate the default rate here, so we have the time here on the y-axis, sorry, on the x-axis, and the default rate on y-axis. We have two periods in the data. And let me just show you that. So the issue here is we have anonymized the data. So we don't talk about the years. These years here correspond to values of 2000, that's period 0, to 2015. And really, if I look at the data, I see two periods. I see this period here, that's a benign period. And I see, should have done the other way around in terms of colors, but I see this period that's, let me make it the other way around. So I see this period, that's the green period up to here. And then I see the red period, which is a period of increased default risk. Yeah. And for our experiment, we're going to slice the data this way. So we're going to have a training period of 0 to 26, period 26. And for our test period, we're going to have the global financial crisis. Yeah. And so the average default rate for this sample might be here. And the average default rate for this sample might be here, maybe even lower. Okay. And so we're going to do the harshest test of all. We're going to estimate a model during benign periods. And we're going to forecast the risk for an economic downturn, one of the worst shocks for global financial crisis in mortgage lending. This is where the very one function comes in handy that's created by the book, is a sort of a tool where you can slice and dice the data into training and test periods. It does also calculate your various feature transformations, things like principal components and clusters. So I'm going to run that. Not much to see because there's no output, but okay. There are then various features. I'm going to include liquidity and equity as discussed. Someone's asked, I said, oh, have you included liquidity? Yes, we included liquidity as the cumulative excess payments at any point in time. It's a bit hard to explain. I need more time for that, but it's a measure of liquidity, one of a couple. We include equity, which is 1 minus the loan to value ratio. We include the loan contract rate. So sort of can ask yourself, should I include it? Because at the end, this is maybe what the bank wants to measure. But at the other hand, loan contract rate also includes information, bank private information one can explore. FICO score, GDP growth rate, principal components and clusters. Now, where are they? Well, okay. They are in the data set that I've just created. So I can comment, let's just comment these lines here. So I'm not going to execute them anymore. And I can have a look. So first of all, of course, I have here a trained data set. We can look at the trained data set a bit more in aggregated terms. We know it has 12,000 rows. So first, the original data set has 41,000 rows. The trained data set has 12,000 rows, and our test data set has 27,000 rows. Yeah. Why test data more than trained data? Well, just because over time the loan portfolio keeps growing in size. So we have a ramp up of the loan portfolio. Normally some people have a larger, obviously, train sample than test sample, but it doesn't matter. For us, the experiment counts, but we want to predict loss outcomes for crisis periods. Now, that's all good. That said, I'm going to now learn do machine learning techniques, and I just want to make this point. I'm not going to use these train and test data sets anymore. I'm going to use these X variables here, X matrices. And if I look at them, so let's first look at the train data. So if I look at the train data, I get a pandas data frame. And if I look at the X data sets, I actually get NumPy arrays. Yeah. And so let's keep going. We then estimate a logistic regression model. And there are various nuances to it, how it works. But we now use a package called scikit-learn. It's a machine learning package. And the method is logistic regression. And we first set up the model, select a model, and then we fit the model using the fit method. And we fit it by specifying the NumPy array of the X features. And now there's some details to that, what we have done with the features and so on. But I think it would go too much in detail. I need more time to explain that to you. But we are basically fitting the observed features transformed for machine learning fit and the observed outcome variables. Okay. And then I can print the parameter estimates of that model. So what's the problem? So it's currently not working. So just 1 second. Oh yeah, it's working. Okay, it's just a bit long calculation time-wise. Okay, so this is a logistic regression model. These are the parameters for the intercept, and then the parameters for various estimates. And now these estimates correspond to these features here, to these features. So liquidity is first, equity second. And normally in econometrics, we have a nice estimation output here. But because this is scikit-learn, it's machine learning, you can print the estimates, but there's no longer this sort of comprehensive table. You can create a lot of that, but it requires use other functions that are embedded in scikit-learn. Okay. And I'm going to show you how to use them in a second. Then once you have done the modeling, you can estimate the probabilities of default. And then one of the most important functions that we have in our package in the book is the validation function that allows you to summarize your model. Yeah, and so this is a powerful tool, the validation function. And I've not seen it from other. This is specific to credit risk. And so what we have here are summary statistics. So we know, for example, in sample we have 12,000 observations. We know that our average default rate is 1% in the data. We then have the area under the curve. It's an important measure. And these measures are important for other things. Regulators may demand it. And the book goes on and on and on about it. But for now, I don't have time. Yeah? I just want you to focus here on, this is the in-sample fit. The area under the receiver operating characteristic curve's number between 50 and 100% is 78%. We see here the fit over time. That's a very powerful chart in credit risk analytics. And then in the lower right corner, we have the calibration curve, which is the diagonal and shows you for clusters, in this case deciles, the combinations of default rates and mean probabilities of default. And what we see here is in sample, the fit is quite well. All these clusters are on the diagonal. The area under the receiver operating characteristic curve is high. You may say it's not high enough because you've seen someone has higher numbers. There's also some literature on that. I suggest you read a paper by Daniel and Blochwitz in 2005, in the Wilmot magazine. It talks about how to interpret these numbers correctly. But anyway, in sample, happy days. Okay. And now we use the same model. That's our model here, but we use the test data and rerun our validation output. And this is where the problem starts, because now we have here the timeline and we have here the outcome. So the outcome is an increased risk. Just see, before we had an average default rate of 1%. Now we have an average default rate of 3%, which is much higher. And so in the crisis, the risk outcome shoots up, but our predictions don't follow. That's a problem of the model. Can we do better? Well, I don't know, we'll try. But in the last chart, the calibration curve, we see that for any average PD level, our outcome levels, the default rates are much higher. So it shows that our model is under predicting the realized default rates. Okay. And then now we can do a machine learning technique. And there's a lot of them out there. We quite like the voting classifier because it combines machine learning techniques. So in this case, we combine a logistic model with a random forest with a neural network. And we can do other models as well. But this is a bit coding. It's all in the book. But you need to effectively estimate these models in separation first, and then there's a technique to aggregate over these models. In this case, there are two techniques. There's a hard and a soft aggregation. We use a soft one, that's a mixture model. And the outcome of that is this chart here. And we see, especially if you look at the upper right chart, that suddenly the machine learning technique is much better to predict the increase in the crisis. Why? Because it's accommodating many of these non-linearities that we have observed. Now, we find similar observations with others. So long story short, should we use machine learning techniques? I think it's definitely what banks should use. Banks have different applications. We can use it for loan pricing, loan loss provisioning, and bank Basel capital regulation. And you may find when the moment you do something that's vetted by accountants, that is loan loss provisioning, or the regulators, that is capital allocation, machine learning techniques, they are not there yet. They don't fulfill one of the requirements, that is transparency, because a lot of these models, I can no longer show parameter estimates. And with that, it may take some time until these models make entry. We are hopeful because we think these models are reproducible. It's not like that they are, okay, if there's no equation, who cares? At the end, you just want to have a good outcome predictor, to have a better system. And so we have a good hope that in 10, 20 years, these models will make entry also to the area of credit risk analytics in terms of bank regulation. But regardless of that, of course, you can use it in loan pricing and anything that's non-regulatory. And perhaps you should. The only comment here is exactly Carlos' comment again. You need to really understand these models, understand the issue of overfitting, to be able to estimate models that are predictive on other loan portfolios and predictive on other time periods. And this is where COVID comes in now again. Let's close the loop to the beginning. COVID has changed so many things in our lives. And it's not necessary that the risk is higher at the moment. It might be higher soon, who knows? But it is the interactions that are different. What if these non-linearities are different? What and so the difference is on every single exposure. And we discussed it, but there's a big problem with that. And so the question is, are then machine learning techniques better to capture that? Perhaps we need to find out. I don't want to bore you with all these sort of COVID stories now, but we can have a chat later. Last but not least, we do offer training events. So we also do that commercially for industry. So if anyone is here from industry and your employer is happy to sponsor you for a paid industry event, look it up. There's one forthcoming on LGDs in September. In that workshop, we will estimate machine learning models grounds up. So we will talk about things like standardization, on how to calibrate and how to cross-validate and tune the hyperparameters. And last but not least, clearly credit risk is our life in a way, except our families, of course. These days we do a lot over LinkedIn in the sense that whenever we have a paper published or something's coming out that could interest you, we share it. And likewise, if you have something interesting, also share it with us, because we live from your experience and observations. So with that, it would be great if you could connect to Daniel and then also to myself.
All right. Thanks a lot.
So that's kind of what I prepared from my end. We can have a chat if you have any questions.
Sure. There's quite a lot of questions over here.
Okay.
Yeah. So yeah. First, thank you a lot for the interesting stuff regarding to the machine learnings and the future trends that it can be applied in banking. There's a few questions over here regarding to the models and the material that you have just presented. The first question is, are there any minimum system requirements for running these models? I mean, it's like, I think maybe the attendees want to ask about the hardware requirements or things like that.
A lot. So even there, we could spend a whole week talking about it. So first of all, you need to put yourself into the shoes of an academic. You probably have the lowest entry because you can, you have many liberties. So you can run it on any computer. Usually universities have big cluster computers. It also means you can change the data. If it's too big, then you make it smaller. You do random sampling. But if you're in an industry, in a workforce, then you have many constraints, and it starts off with you're working not by yourself, you're working in a big team. What if you have 100 modelers? In order to do all of that, what we've seen today, one of the inputs or requirements would be that the whole team uses a language that's the same. So not R, SAS, and Python, choose one. That you have coding standards, guidelines on how you communicate with each other, how people implement that in the workflows. You then, because of all these versions, if you to use Python or R will come out, you need to have environments where people use the same versions, not that the next person uses the same code and gets a different result. And then, of course, there are also, once we enter the machine learning, technical requirements where you need a lot of computer power. And so we have used one package, there's many other packages, and you need to find ways on how to process that. And this is where a lot of companies these days use, for example, the Amazon servers, AWS, because they can rent a server and computing space. And of course, on Amazon, you can run all these programming languages and process. But there's a lot of system architecture that needs to be going on at the bank level. And ideally, that's done by the modelers, so someone who's literate in all that. And then also IT architecture specialists. So very quickly, this can be very complicated. And there are different processes, for example, and of course, some processes are quicker, and you need to make wise decisions.
Yeah, come back to that kind of question. I remember the time.
Just one comment.
Yeah.
One of the many reasons I didn't show you execute, for example, the last model is because it takes a lot of time, a lot, yeah. 15 minutes. But for our seminar, we don't have the luxury to wait.
Yeah, sure. Yeah, right. Thanks, Harry. Yeah. Yeah, I think the choice of the software is also depend on the regulator as well, right? Because like last time I remember at the time when I work in the banks, at that point of time, the regulator tends to accept SAS rather than just in the results produced by R or like the open source or thing like that. Yeah, because like with SAS, they got the whole company to back up for the output and things like that. Yeah.
Yeah, just 2 comments on that. So the regulators are losing up a bit. So they also acknowledge, the entry of R and Python.
Yeah.
But second, also for a reason, it is the version control problem is a huge issue in R and Python.
Right.
And Daniel and I, we have worked on 2 different computers with different packages in the book. And there are issues we had to overcome to get consistent results in terms of this version management.
Yeah.
And if you just let someone loose and, you know, not within the bank, but sort of outside of the bank organization, think about accountants, consultants, then this is a problem. And so regulators, for a reason, are a bit critical.
Yeah, right. Yeah, thanks, Harry. Let's go into the next questions. Here, we'll come back to the splines regression or the polynomial regression. There's a question about like when do you use the splines regression instead of the polynomial? I mean, it's like whether we will trials and errors or
yeah. So regardless of what you're doing, be it regression modeling, machine learning, I'm not a big fan of any trial and error. So, you know, there are approaches where you have, for example, stepwise and forward and backward approaches that test all sorts of combinations. This is what engineers would do. I think if you work in credit risk modeling, you are usually of an age of someone who's finance economics literate, even if you have a background in engineering. But you should always try to ask yourself, what are the important drivers and what regions make sense, so that you're not running everything like a grid search from A to B, but you're focusing on areas that are important. And so because there you get much more, at the end, everything's limited, your resources are limited, but you need to come out with the best model with the resources you have. And you only achieve that if you kind of know what you're looking for. And so, for example, with the LTV ratio, if you read 1 or 2 papers on mortgage lending, very quickly you know that most of the activity is from LTV 80 and above. And so with that, I wouldn't look too much when modeling call it the LTV below 80 or below 60 or below 50, whatever your threshold is, but you need to be careful on modeling than everything above. And the higher, the more careful you have to be. And so there are, you know, be it also a discussion around missing values, on selection, biases, outlier discussion. So there's a lot of problems in econometric modeling. In all these cases, you build better models if you are a subject matter expert, for example, on bank lending, or for example, if you work in telecom on forecasting churn rates for consumers. So whatever you're doing, having a subject matter expertise is important, even for modeling.
Thanks a lot, Harry. There's a few other questions as well. Let's look at the attendees is very exciting about this. The next one is like this come from the problem that he or she face in practice. So the question I think from Ling asking us, I had a problem with the p-hacking. When I changed the way I split the train test sets, the result changed. Even after combining with the cross validations and the hyperparameters tuning, this phenomenon still happen. Is there any other robustness test does he or she should do?
This is this is an important question, but it's also a very hard one to answer because I would need to see the data and work with it. I can only make a general statement. Whenever you get, in different runs, different results, or things look too good, you need to trace it back. And where there are techniques, and so usually it's a comparison techniques. You can compare different models. You can compare, for example, if you have 2 settings which are very similar and you expect the same result, but it changes when something's wrong with that. Just any call it suspicion that something's wrong is usually tells you that there's something not robust. But it is a general rule for many econometric analyses, and it's very, very hard to now give a solution that then works and then you have a perfect model. Every model is imperfect by definition. It could also be that you are worried about decimals and so on, which are not really perhaps economically meaningful. Could be, but I would need to understand more about the problem.
Yeah, all right. Thanks, Harry. Yes, I think this the most important thing is to look at the data and the characteristic of the data that just working on in order to identify the exact problem, right? The next question is like, are there any limitation of the numbers of input data for a model? That's the model that you use logistic or the mixture between the neural network or things like that. And are there any minimum system requirement? Oh, this one we already covered for this. Are there any change to update the system because increasing the number of the data, and how does it affect the timeline? Yep.
So the computation times or the processing efforts, of course, increase with the size of the data you process. This is because you have more features, or this is because you have more observations. So increases in both dimensions. And also, with Python R, you need to be careful a little bit how you use work memories of computers. So for example, as SAS, if you use a commercial solution that has been designed for panel data sets. And so what they do is they very resource efficient read observations into the workspace, process them and take them out. But with Python R, often they bring the whole matrix or the whole array into the workspace. And it's not efficient to process it this way, but there's other packages you can include that allows for a more resourceful, call it data management. And so that's also possible. But you just need to know about the problem and the way to solve it. But regardless of that, of course, the more features and the more observations, the more computation time and computation resources you need.
Yeah, thanks.
And just give you data, and there's no open end there. So some models minimum a second, of course, but you can have models that go to infinity. So if you set it up in the wrong way, you can wait and never get a result. So you really this is a very important issue.
Yeah, exactly. Yes, I remember the time when we work on the like two-step modeling, getting to the new kinds of modelings and with the non-linear optimizations, numerical one. And at that time, I need to run parallel 3 computers at the same time, one from my laptop, one from my desktop at home, and one at the working place, in order to run the different kinds of the scenario that we working on. Yeah.
Right. You can always start small. You start with a small data set, observe the time, and then you increase the size, and then you can get a feeling what size and time means, and then you can sort of say how much time do you want to invest to get a result.
Yeah, exactly. Yeah. All right. I think the next question is from a PhD that's interested in work on the the machine learning area. So the PhD asking us, if I want to submit a machine learning models to a journal, what's your advice on how to convince the reviewers to believe in my results? I've seen many machine learning papers claim to outperform out sample, but who knows if they actually use the out sample data to fit the models.
That's the hardest. Yeah, and so we as a discipline, the more we submit papers that are sloppy, the more we submit papers that use the methodology, the less accepted it will be. And so basically you need to find experimental setup that sort of ensures the integrity. A little bit comes with a reputation. So there are I think referees often they have a feeling sort of about people's work, and so if you come perhaps from if you have done some work in validation, maybe they trust you more, because one of the dangers also Python allows you a suite of validation tools, like our validation function, that you can apply and you can show fit. But the biggest problem, overfitting, you need to tell that story, you need to address it, and so not just present results and say this is a better model and be done with it. You need to show why it's better and by how much it's better. But that's easy said than done, because often there are limitations. For example, for many applications, you don't have enough data to have, in many cases, you need 3 data sets, a train and a test, and then you need a test data that you only apply once. So with that, you often don't have the luxury to have these 3 sets. And so perhaps one advice is look for applications where you have a lot of data, where there's a lot of issues. So if you have a data in credit risk with not many default events or not many time periods, perhaps you don't want to even start doing machine learning. But again, like in our case, we feel we have enough data, so we do it. But for example, if you did Australian defaults and you have, so we have in this data set, just give you an example, 15,000 default events. We feel that's adequate, and we have an economic downturn, and we have 16 or 17 years of data. But if you have, if I look into Australia, and you may have only same time period, but say only a few hundred default events, and then you have 10 a year, then maybe you want to perhaps not apply machine learning techniques. Huh? So I think it works the better, the more data you have in general.
Yeah. Thanks a lot, Harry. I think the last question is like get interested in the book that you introduced. And also the events regarding to the trainings, like in more details about the deep credit risks. And the attendee asked us, does the books just give the in detail discussion in terms of the model that you presented, and also in the application of those models? Yeah.
So sorry, the question was
the question is like whether the book provides all of the detail regarding to the model that you presented, and also the application tactics.
So definitely the book front to end is the whole execution. So there's not a black box or anything. It takes you from data to results. So there's no gap, and with that, it's very honest. But you know, you also find that some techniques and for certain data that perform better than others. And it also enables you to do the work, but it doesn't. So it brings you to a level to implement the models, but at the end, the empirical work, you still have to execute. So you have to understand the data, describe the data, you know, find the right features. So it enables you with everything you need, but there's it also opens problems. So it raises then the issue of overfitting, and so with that, it makes models more robust in a way, but it also creates new work. I think it's perfect for someone who wants to learn and build better models.
Yeah, sure. Thanks a lot, Harry. The other thing is some of the attendees is also interested in the events regarding to the trainings in deep credit risk. Can you like give kinds of information maybe in the chat box about the link and things like that? They can find out the event detail.
Yeah. So it's I'll put it in. So it's I'll put the link in. I'll put the link in the chat.
Okay.
Also, if you connect via LinkedIn, I can send you an update if things change or anything.
Sure.
So that's a link for the event. Okay. And also, just connect via LinkedIn. So we run events quite maybe once or twice a year, not so often, but and also, you know, we all academics and we write papers, and it's interesting to see what people are working on. Or if you, feel you work in a related field, machine learning, credit risk, it would be great if you connect and, just send a paper to get a feeling what you're working on, what the issues are, and stay in touch.
Yeah. Thanks a lot, Harry. I myself actually also attended the Harry class regarding to the credit risks and modelings before. But at that time, I was I'm learning I was learning the SAT rather than Python, right? Like back about 2 years ago, I remember. Yeah. All right. Yeah. Is there any other question from the attendee? Okay, Jans, you asked a question regarding to what if city is still in lockdown? You mean the physical class, right? But I think the master class can be online, right?
Yeah, it's in Zoom. It's in Zoom.
Oh, it's okay. It's in Zoom.
But that said, we are hopeful that one day we will be all vaccinated. So it's always a call and everyone get vaccinated, and that we open the border. I think at the moment in New South Wales, it looks like we are sort of more following the European American model, that we all now get vaccinated, and hopefully this whole COVID story comes to an end very soon. That's all I can say. And then, of course, we would love to see you in person, and not only for the workshop, but also if you want to meet up. Daniel is in Regensburg, Germany. Many of you guys might be in Germany or Europe. And then also I'm in Sydney, Australia, and we all travel quite a lot, COVID permitting. And so if you want to catch up and meet in person, let us know where you are, and we'll find to each other.
Yeah, I very much hope that's the when the COVID situation is resolved, then we can also create kinds of class in New Zealand as well. I'm very much hoping for that, because I very love the the social interaction after it's a class. We got informal discussion, and we can exchange quite a lot of the idea and problem that we face in the practice in banking, right?
Yeah, and credit risk has lots of stakeholders, and you find there's regulators, there's industry practitioners on different ends. So you have the banks, and you have the fintech companies, and you have the rating agencies, and so it goes on and on and on. Who is actually interested in credit? Or you could do a quick look in LinkedIn, how many actually people work in that industry. It's become an industry perhaps globally that has 100,000 members. So this is, credit risk is not small anymore; it's huge. Can only encourage everyone to be part of it. Club.
Right, and the salary is high as well, as I may say. Right. Okay, yeah, I got a question in terms like the admin step one. Will the recording be shared to the attendees? Ross, I can answer this question for you. We have the YouTube channel for our network, and later on the recording is going to be shared on the YouTube channel, so you can review the video anytime you want, right? I think we will, all right, okay. We will, I think, upload the videos about like later today or tomorrow, all right? If we do not have any further questions, then I think we can end the webinar here. Thanks a lot, Harry, for giving your time, giving a great talk, and inspire us about using the machine learning in credit risk modeling. And thank you, you all for joining us and attend the webinar. Let's make our event successful, and yeah, hopefully we will organize even more useful webinars and other events in the future, and we welcome you join in our future event as well. Right? Yeah, thank you very much, and hope to see you in the next event. Right? Thanks, Harry.
Thanks, guys.
Yeah.
Thanks for having me.
Bye for now.
Bye, everybody.